sheet, that is equity. Equity is an important component of the total analysis of the balance sheet of a company, and equity will also show the fundamental of the company, and equity is capital, reserves or capital plus retained profits, or equity is assets minus liabilities. So, we would like to see today how this equity changes and why this equity changes. But before that, let us understand the components of the equity. I just picked up two companies from US. One is a power company, AES, another is a Microsoft. You can see the composition are preferred stock, though both the companies do not have preferred stock, common stock, which is also called the ordinary shares in other countries, and equity capital in India, retained earnings, the treasury stock negative, we'll spend time on that bit later, capital surplus, that is the premium raised on the issue of shares, and any other negative or positive equity changes. So, the word equity is a composition of several items, but why at all the equity change over a period of time? The equity can change if there is a issue of capital, equity can change if there is a buyback of capital, equity can change if I retain the profit, not distribute it, and if equity can change if I distribute the profit in the form of a dividend, both cash and the stock dividend. So, see how the equity is changing for two companies. One is a Microsoft, the other is a Blackboard, which actually also in the same industry, but which provides technology services for solutions for academic institutes. So, both the companies' equity has increased, both the companies' equity has increased, and in this case the increase is because of a slight increase in the common stock, the other one is because of the profits they have made. If you see, both the companies have a negative retained earnings, that means they were making losses, but in the last year or they have started making profits. So, therefore, the negative retained profit is coming down. As a result, the total shareholders equity has changed. So, as we mentioned, the equity can change if there is a retained profit, equity can change if there is an issue of capital, which is what happened here in these two cases. The issue of capital can be done to public at large, issue of capital can be done to the existing shareholder, which is called rights issue, or maybe a bonus issue. The rights and bonus are to the existing shareholder, where the public issue is issued to the public at large. It can be an initial public offer or a subsequent public offer, but in this case the shares can be issued at a par or at a premium or at a discount. If the shares are issued at a price higher than the face value, then you call it share premium, which is generally shown as the capital surplus, in the US companies. In Indian companies, you more call it as a share premium. The rights issue, the existing shareholders are given the offer and they have a right to accept it or buy it or not to buy it. They do not have a duty to buy it. So, therefore, it is called rights issue. They can sell it to others or they can just waive that right. So, therefore, rights issue, public issue increases the cash, increases the capital and increases the equity. In case of a bonus issue, which we will see a bit later, bit more in detail, is a distribution of profit. So, the rights issue is a raising of capital, where the bonus issue is a distribution of profit. So, as I mentioned, dividend is a distribution of profit among the shareholder. It can take the shape of cash dividend or stock dividend. If it is, let us take the example of this company, an hypothetical, with a capital of 100,000, reserves of 112,000, the rest assets and liabilities. Let us see what happens if there is a cash dividend of 50% or a stock dividend of 1:2. If there is a cash dividend, cash goes down by 50,000, cash goes down by 50,000, 250 becomes 200, and the reserves goes down by 62,000 to 62,000. As a result, the equity falls from 212 to 162,000. But if it is a stock dividend, no change in the cash, whereas the reserves goes down. So, the total equity of the company remains same, but the number of shares issued or number of shares on the balance sheet go up. So, in case of a cash dividend, cash goes down. In case of stock dividend, no change in the cash. In case of cash dividend, the reserves fall, as well as in the stock dividend, reserves fall. The dividend will affect the book value per share. Book value per share is also called the asset backup per share, which is calculated as equity by number of shares or asset minus liabilities by number of share. Let us take the example once again. So, in the previous examples we saw cash dividend reduces the reserves, stock dividend also reduces the reserve, cash dividend reduces the cash, but the stock dividend, the cash is not changed, however, the capital is increasing. As a result, the number of shares in cash dividend remains same, but number of shares in stock dividend goes up. So, therefore, in both the cases the book value falls from 21 per share to 16 and 14. That means, with the distribution of dividend, whether as a stock or the cash dividend, the book value per share falls. So, there is an assumption that all other things remaining constant, the distribution of dividend leads to the fall in the price. In an accounting class, we say that is because the book value per share falls. Therefore, there is a need to understand, which we will pick up in one of our future sessions, that is there a link between the distribution of dividend and the market share, market price. As we saw here, the price is a reflection of the fundamentals. The fundamentals are reflected by equity. So, therefore, if the market value will fall if the equity per share falls. Thank you very much.